Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hello, Jim.
We have a federal budget coming up very shortly. What would you like to see in it to get the economy going and maybe help out the average Canuck?
Well, I would like to see some investment in infrastructure, and particularly innovative infrastructure around energy, resource management, efficiency, lowering our costs on things like utilities. I would like to see some longer-term investment, although I'm concerned about the fact that we're already in a deficit position and we haven't even got into the next recession. So, some short-term stimulative ideas for longer-term benefit, but also just trying to manage the fiscal picture right now as tight as possible.
Do you think the government's been overspending when they should have been maybe pulling back?
Well, they've mostly been downloading expenditures onto the provinces, which has been a common playbook around the world where federal governments have been cutting their spending by giving the cost to state and municipal levels. So I just think we need to factor in the reality that we're 9 years into this expansion and we're very likely closer to the next recession than we have been in many years. And that means we're going to have to probably run significantly higher deficits once we get into that downturn period. And I think, we have to stop trying to incent more consumption at household levels through adding more debt to the system in ways that don't actually increase our productivity or help us in the longer run. So programs that are, fat and wasteful and spending money on, as I say, promoting debt and consumption have to really take a second seat here, a back seat, and we have to go back to basics of how do we reduce costs, get more efficient.
Should we bring back Canada's savings bonds?
Well, there's definitely a place for Canada savings bonds, guaranteed deposits like GICs, that sort of thing, and I definitely think that the public needs that kind of thing to build up their savings. They don't want to put all their savings into very volatile and dangerously priced markets, and in many cases it's completely inappropriate to do. So I think it would be great for the government to allow citizens to collect interest by, putting money towards the pot, so to speak. So yes, I think it's high time we started thinking of, less speculative focus and ideas and more on things that, as I say, will retain more of our cash flow in our country and increase both by allowing people to invest in their own government and infrastructure, the citizens of the country, but also through wasting less by lowering our cost structure, as I say.
Do you fear the federal government might continue its attack on small business?
Well, you see, I don't agree necessarily there's been attack on small business. Having a small business myself, I'm paying attention to the changes that have happened, but in some cases the changes have been aimed at trying to close loopholes where people have been taking advantage of the system, so to speak, and writing off things that really were not legitimate business expenses, and I'm all in favor of that.
Now in BC, the government is going to impose an employer's health care tax to replace the average person paying a medical premium to the government. A lot of people have said that could be a job killer. $1.8 billion in extra taxes for British Columbia businesses.
Yes. Well, unfortunately, we're in a predicament where we have a dramatically aging population, people going into their 70s at a very rapid pace now as a percentage of our population. This is in Canada, but all over the developed world. And we also have a epidemic of bad health, which is largely related to lifestyle issues, bad food, and lack of movement and exercise. So we have these two perfect storms which are going to escalate our healthcare costs, not only for the older folks, but for the younger folks, because they too have succumbed to a life of poor food and not enough movement. And so we have a critical crisis brewing in our healthcare system. So it means that we're going to have to increase contributions to fund the benefits that are needed for these people, but it also requires that we're going to have to figure out ways to incent better behaviors and to tax the bad foods and do all that kind of thing. So it's a very complex solution, but I do think in the near term, getting more lean and mean, getting more efficient, as I say, in the hospital and the healthcare system, but also increasing the funding. I mean, you just can't make this math balance unless people are aware of the bubble of people that are coming into this system that are increasingly prolapsed onto the healthcare system without any personal discipline or control over their own lifestyle choices. So we really do have to get our head around how to lower the cost, as I say, but also that this is going to be very expensive because we've been so late in coming to this issue.
More incentives for people to get out there and maybe pound the pavement. I mean, I just know personally, my wife took part on a government program where if you completed the exercises and everything, you got a gym bag, probably worth $10. But a little goal like that could go a long way in helping the average person perhaps do something. When you get a little reward, you can do a lot.
Well, it is true. Humans are like that. We like to have tangible reward structures. So again, since we're going to fund this mess right now in the healthcare system, and it's going to take a ton of tax dollars, anything we can do to be preemptive or proactive in changing behaviors before more and more people come into the system with worse health is a smart thing to do. So it's always a function of what's the budget, and then working within what's a reasonable budget for ways to make ends meet.
We'll have more with Danielle Park right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, students now graduating with $100,000 in debt. That's not unusual. That used to be what you paid for a mortgage. Mm-hmm. And you're coming out of school at 22, owing a fortune. What can we do about that?
Well, you see, this is another point that I've been making for some time. It's a problem for everyone in every age group. It's not just a problem of the young people. The reason I say that is we have another massive wave happening right now. It's already started, and that is that the older people, the 70s and before that, even the late 50s and 60s people, are very much focused on how do we get more efficient? How do we have less things to look after, less maintenance costs, less insurance costs, less utilities, all these carrying costs. So what they're looking to do is find people to take their stuff off them, right? To buy their houses, their vacation properties, their boats, their campers, all this stuff. It's all this move of the baby boomers who are looking to downsize all their cares and worries and costs. And so what they want is for younger people to not only come in and pay higher taxes, pay more health care premiums, but they want them to buy this stuff off them. And so we have this problem because, as I say, the amount of student debt has become a crippling weight on young people. It's crushing of innovation and flexibility, of their ability to start small businesses, of their ability to take risks with lateral moves or career rejuvenation, because they're saying, gee, I've got all these payments, I can't possibly, try and make a change right now or take a risk on starting up something which may not produce income right away. So it really has this a very negative effect on the economy overall and on entrepreneurism, on upward mobility. So what's happened is I'm all for education. I'm all for self-improvement, but we've had a few different phenomena at work at the same time. One has been the pushing back of employers and corporations saying, in the good old days, they used to take more responsibility for their workforce and say, if we want good people, we have to train them, we have to teach them what they need to know, we have to fund their education or their apprenticeships. What in the past couple of decades, you've seen this movement of corporations saying, bring us the finished product, so to speak. We want everyone to have a postgraduate degree or a post-secondary degree or already have their papers when they come to us. And so that has really pushed a lot of people to have to go fund everything from scratch. And it's much more splatter pattern, right? It's a lot less focused. When you're just kind of going to generally educate yourself, you're not really sure where you're going to end up for work, and you're just hoping that what you're taking is going to be in demand. And the other thing that's happened, as I said before, in the credit bubble, is really incented because there's been this securitization, financial markets, everything has come to such a fevered pitch of add debt and stir. You've got governments underwriting a whole bunch of which seemed to be perhaps noble causes, like let's get everyone educated. The problem was that they were funneling credit, enabling cheaper and cheaper money to be advanced to students. And the beneficiaries of those government subsidies, because they are subsidies, is really the administrators and schools themselves, which have expanded their facilities and their wages in post-secondary, state-of-the-art stadiums and every kind of fancy building. It all looks good on the surface. The problem is that the cost of education has skyrocketed in the process, and the only way we've been able to afford to maintain all these people in these schools is by adding to the debt every single year. So we've now, as I say, come to the end of the line of credit in so many different ways in the world, and it means that, we're going to have to write off a good deal of that debt that was never going to be repaid in the first place, should never have been advanced to the extent it was. And we have to look at cheaper, more effective ways to educate people, more for less, So it's going to take a change of mindset for the institutions, but it's also going to require that governments don't just throw endless amounts of money at certain, buzzwords like student education without, working with the schools to figure out, again, what's a decent budget. First, let's start with a budget that's connected to the income flow that a person is liable to be able to get when they come out of that program. That budget then has to work backwards, where you say, fine, this is the amount of money we can spend on this education or this institution. So this is the amount of students we need at this amount per head, and this is the resources we have to work with. When you have the past few decades, it's all been about just keep increasing the cost and we'll get more debt to be able to afford it. We're really now in a new world where that's at a breaking point. And it's, again, as I say, you've got to start with a budget. I tell this to individuals all the time as well. Don't tell me what you want to spend and then this is what you have left to save. We have to figure out what you need to save in order to hit your goals and then work backwards with how can you make your expenditures shrink to allow for that saving. And if we can get that mindset in governments, in the institutions of education, in households, and indeed in corporations who have been just adding debt recklessly to do stupid things like buy back their shares to make prices go up with no net productivity enhancement. Those are really, behaviors that have been rampant in this speculative mania we've had. And I think, the next phase will be all about being a lot more efficient and smarter.
We'll have more with Danielle Park right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, after that mini meltdown on the stock markets at the start of the month, what are you telling your clients right now? Should they just hold on to cash and wait for things to go down and get bargains? What's the strategy?
Well, our predominant holdings have been government bonds in the past couple of years, and that's been on purpose because we have been looking for valuations to be investment grade, investment worthy, and again, when things get into such an extreme state of overvaluation as they are today, both on corporate debt, on derivative products, on equities, all the income-producing stuff that everyone's been pushed into because rates have been so low have really gone into a very unattractive price levels, which mean there's a ton of price risk and a very low yield to compensate you. So the reason that we've done that is because we've seen that the pace of debt that's being added to households and corporations is not sustainable, and that means that rates could only go so high. So the chart that I put on the blog today is just making the point. So, each time you have a business cycle, you typically get more debt added during the expansion, and that fuels consumption and allows people to hire and, people to buy houses and goods, and everything goes up to a certain point when the amount of debt takes so much of the free cash flow, whether it's from, as I say, business revenues or from households, that consumption is squeezed and they have to start reducing what they can spend. At the same time, because the central banks always get concerned about overheating, although they're very late in the cycle and they always come to it behind the curve, they start raising rates. So we saw that they waited forever this time, way too long, many, many years before they started raising rates. But now they're bound and determined they want to normalize things. 9 years into the expansion, they're worried about meeting the next recession with no room to cut rates. So we've seen this concerted effort over the past couple of years for them to start raising rates. So already in the last 18 months, we've seen a 119% increase in the benchmark rates, like the U.S. 10-year Treasury, for example, which many credit facilities are priced off of in America. We've seen a similar, spike in interest rates in Canada. And again, they price their mortgages typically off the 10-year Treasury. We price ours off the 5. But the theme is the same. If you look at since 1982, interest rates, generally speaking, have been falling. And during that time, people have added more and more debt each expansion cycle. But each time, you've got to the same business cycle peak where, as I say, rates have started to rise and people's cash flow is crimped and they can't consume and the economy falters, and then central banks come in and start cutting rates again. So in the last 4 recessions, what you saw was that an increase in the benchmark rate of about 50% was 50 to 60% was as much as you could handle before the economy weakened on the drop in consumption and went back into recession, and that's when central banks start slashing their benchmark rates to try and revive consumption. This time, we had such an extreme low in about June of 2016. The 10-year Treasury yield in the U.S., for example, was about 1.34%, is the lowest we'd seen in 100 years. And in many parts of Europe, the yield cycle, the rates were actually negative. So we really hit a systemic low for interest rates worldwide about 18 months ago. Since then, we've seen, as I say, this increase in rates. But we're already seeing things like Canadian retail numbers this morning tank, consumption weaken, slowing, housing markets starting to weaken, housing starts weakening, all this stuff. So I think we've already, in just the last 16 months, we've had this almost twice as much of a tightening cycle. From the extreme low, we've had now 119% increase in rates, even though on a percentage point basis, it doesn't seem perhaps like a great deal to go from 1.3% on the 10-year Treasury to 2.9. It's still a relatively low interest rate, but as I say, the net effect on cash flow is enormous. And so, although people are saying they think they'll see 3 and 4 more rate hikes in the coming year, and that central banks are going to continue, and they want to get back to this dream of, what they consider a more normalized rate of 3 or 4% on the 10-year, or 4 or 5% is their sort of thinking. I think we're going to hit a recession far before they get anywhere close to that level of normalization. In fact, as that chart suggests, any increase above 60% historically has been enough to bring about the recession, and we've already had an increase of twice that in the last 18 months. And let us not forget that we are many trillions of dollars more indebted on every level, government, business, households, everything, than we've ever been in history. So I think you couple the extreme levels of debt in the world with the extreme increase, the sudden and dramatic increase in interest rates, and you're more likely than not to see a slowdown in the economy, which will bring a cutting rate phase. And during that period, they won't be able to stop the recession or stop a bear market in financial markets, but what they will do is they will, create a bid, so to speak, for existing government bonds. That's typically been the response. After this spike where things have sold off, you're going to get a flight to quality again where people start going to, things like cash, because no one's got cash right now. It's at very low levels around the world because everyone's been putting it into these overvalued assets. So there's going to be a crunch for people needing liquidity. They're going to want to sell more of their illiquid assets, their boats and trailers and things, and also their securities, raise cash and go to things where they perceive capital to be secure. As we were talking about earlier, government savings bonds, guaranteed certificates, and the highest quality government issued bonds in the world typically are where people go when they're looking for liquidity and safety. So I think, that's a long answer, Jim, but the article I was trying to put on is just to make people aware that the interest rate cycle has already increased enough to very likely prompt the downturn that is now long overdue.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, her website, jugglingdynamite.com. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.